Hey, what's up guys, Michael here. In today's video I will be talking about the chart patterns that every trader needs to know. So basically I will be discussing all of the categories, the bilateral patterns, the continuation patterns, and the reversal patterns. So as you all most probably know, the continuation pattern is basically a signal for us that after a strong move to the one side, to the upside or to the downside, when such pattern occurs, the price will continue moving along with the previous move. Reversal pattern indicates for us basically that when after a strong downward or upward movement, such pattern occurs, basically we will get a reversal movement. And bilateral patterns are basically the ones that can suggest the either way, or the continuation or the reversal movement. So yeah, let's start from the presentation. Let's start with the topic. So yeah, must know chart patterns for the traders. Okay, and first we have the triangles, and they are the continuation pattern. And the first thing that I need to mention as for the continuation patterns, basically at best where you should look for them is on mid-term, we can say, time frames, like 30 minutes time frame, 1 hour time frame, and sometimes 4 hour time frame. But basically 30 minutes and 1 hour time frame, and maybe even lower, smaller time frames, are the ones that where you should look for those chart patterns when they occur on higher time frames, or if you will go and analyze the bigger amount of time, bigger time period, you will see that many times they will be more or less directing either move to the upside or to the downside. So therefore it would be hard to predict the price move based on the formation of this pattern. So as for the triangles, we have couple categories, couple types of triangles. So basically we have the descending triangle, which occurs after a move to the downside. You can draw the descending triangle by placing a straight line on the lower points of the formation. So basically the price should stop couple times on more or less the same price, that after when you could place a line on top of them, it would give you this straight line, and the highs should be, the first one should be the highest point, and therefore then consecutive next one should be lower highs respectively, and after which this triangle is formed. Ascending triangle, the opposite situation. We have the move to the upside and couple of highest points which should be created on more or less on the same level, on the same price level, after which when you would draw a line should give you this straight line, and the next consecutive lows should be higher than the previous one. Therefore when you draw a line it would give you this triangle, and basically yes, they should break out on the tightest point. When the price range is very tight, they should break out, suggesting the continuation move. So symmetrical triangle, the situation basically a little bit different. When we have it can occur, of course, the symmetrical triangle either from when we have the move to the downside, the triangle is formed by the particular price move, and it can occur basically from the opposite side as well, when we have the move to the upside and the movement is just reversed. So broadening triangle also, it's something that you should pay attention to, and it is basically a reversed symmetrical triangle. As you can see, first we start from the very tight price range and it starts to broaden, after which it goes straight with a strong move. It breaks out of this range either to the upside or to the downside. So basically it occurs on both trends, either uptrend or downtrend. So now let's check some examples, and first we have an example of ascending triangle. And we have clear upward movement, small correction, upward movement. And right here you have more or less the price stopped many times at the same level. And the lows of this particular price move are higher, 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 higher. Of course, this is a real market example, so you need to have that in mind, that those examples will not be perfect, right? You have here that the formation was broken, suggesting that we could have some move to the upside a little bit sooner. It was neglected. Again, false move, but eventually the formation was broken through to the upside, and yeah, the prediction was correct. We have further continuation of the uptrend, but before that, of course, the market makers tried to stop us out of the market. So you need to have that in mind, that the stop losses need to be set correctly. You need to, test it by yourself. And also, that I didn't mention in the beginning, the chart patterns that I will discuss today, of course, they are very popular ones. You can find them almost anywhere. But what you need to have in mind, that particular chart patterns works different in any asset type of asset class. So what you need to do before, of course, getting those patterns and starting to trade with them with the real money, test them by yourself. It's not a guarantee that after forming of such pattern, the continuation will occur, for example, right? So basically it means that the price after creating such pattern moved in a particular direction. So this is what you need to have in mind. It's not a guarantee. The losses will come eventually. You will take some losses eventually while trading those patterns, so you need to have that in mind. It is best, of course, to combine those patterns with some other strategy as well. And you need to have in mind also scenarios like this. So you need to take those things into account and have that in mind, that sometimes before doing the right move, the market will try to, kick you out from your position. So that's the first example. Now let's move to another example. And this one is the descending triangle. So we have clear downtrend. The price stopped over here and the price was starting to range narrower towards this point, right? So we have this level where price stopped clearly. You could see that, right? And right here it started to getting the range started to getting narrow, and eventually it broke down to the downside, thus continuing the previous move. But as I said, it is a 1 hour time frame. It's a continuation pattern. So basically this move doesn't necessarily need to be very strong, right? As you can see on this example, the price went down. If we could, set our take profit based on this price range, we could earn money, right? But if you could try to take 2R or 3R, you would be stopped out most likely at the break even somewhere here, right? So you need to have that in mind, because from this moment the price reversed in opposite direction. So it is very crucial to to have those things in mind, that continuations pattern doesn't necessarily always have to mean that the price will, make another couple hundred pips in one particular direction. So this is a domain of reversal patterns, but we will talk about them a little bit later. Okay, so let's delete that and check another example. Again, real life scenario situation. We have another descending triangle. And we have here clear downtrend, move to the downside, this kind of move again, trying to break through this level. We have clear situation that the price stopped at this particular level. The range was getting tighter and tighter, and therefore we broke out, but first to the upside before going in the right direction. And you need to have in mind that market makers will try to, you know, kick you out of the market. So this is the real life example, and it doesn't necessarily mean that always it will be like that, you will have a clear downtrend, the price would stop here, something like that, and therefore clear continuation. It rarely happens. But I choose those examples to illustrate you what might happen in the real world, we can say. Okay, this is the example of a symmetrical triangle. So clearly we have moved to the upside, very strong, clear move. The small indecision in the market. We can clearly see how the price, what price formed over here, and again breaking through to the upside, retest of the previous level, and then continuation. So yeah, as you can see, these are the best places to look for continuation pattern after a very strong move, when you have indecision in the market, and then you are looking for breakout of this particular setup. So how you should trade those chart patterns? Basically, of course, the trading terms depends on your strategy. The basic way, the simplest way, is to, you know, set your entry after breaking the level to the upside or to the downside. If you have the opposite scenario, the stop loss should be below the whole formation, and the take profit, it depends on the market situation, it should be minimum the range of the whole formation. Or if you have situation like here, when there is a very strong movement, the range of the price was very high, the continuation pattern was very small, then you could then you know, set take profit at 2 or even 3R. So the risk reward ratio is better in this kind of scenarios. So okay, let's go further with the examples. And now we have the example of broadening triangle, and these are two examples in one, we can say. So first we have the situation over here after a clear downward movement. The broadening formation occurred, right? And you see it was broken through at this level. The price retested the previous move, and it went further to the downside. Therefore suggesting that we could, you know, take 2 or 3 Rs respectively, because the formation was in a very tight range. The candles were small, price range was not that big, but the whole previous move was very big, therefore suggesting us that the continuation could occur on a higher scale. But what happened? We had the price moved over here and then reversed to the upside, but strong move, 2 strong candles, we broke through another strong resistance. And what happened again? The broadening triangle has formed, and we bounced from one side, second, third, fourth over here, and we broke through at this level. So as you can see, those formations work. We have both directions, from the upper move to the downside, and from the downside move further to the downside, and from the upside move further to the upside. But as you can see, these are examples from 1 hour time frame. Therefore, you need to have in mind the take profits and target levels. So okay, let's go further. Next one is the flag. So flag is a continuation pattern. Basically, many times you will mistake flag with the wedge or something like that, which are bilateral patterns. But most often the flag, when it is formed, it is after a strong upward movement, after a strong downward movement, and we have the consolidation that occurs in the opposite direction to the trend. So what I have on me, if the move was this kind, and so the consolidation occurs in the opposite direction. When the price is ranging, bouncing off those two lines, when you draw them, they need to be parallel to each other, therefore suggesting that this is a flag and it will be broken out to the upside eventually. So now let's check examples. Okay, and we have an example of a flag, a small one, small flag, we can say. We have clear upward movement, the consolidation, we can say a little bit here, continuation, and right here we have this small flag. We have strong move to the upside, and if we will draw the lines from the highs and from the lows, they are parallel to each other, and we broke through to the upside. And of course, stop loss, we can say we can talk about right now only the basics. So 1 pips plus spread below the lowest point, and the target, the range of the whole formation, so from the highest point to the lowest point. And yeah, it depends on the market situation. If you are watching the smaller time frame, as we have the example over here, that this flag was relatively small, we could take 2 or 3 hours respectively. But if the move wasn't that very strong and the flag was broadening, was in very broad range, the price was moving in very broad range, therefore I would not I would not take such bold move, we can say. Okay, so let's delete that and go further with the presentation. Now we have a triple bottom and a triple top reversal patterns. So basically, when they occur where you need to look for them. First thing is that at best you need to look for them on the higher time frames like 4H or daily. That's the first thing. Second thing is that you need to look for them on the major support and resistance levels. So triple bottom you would be looking for on the major support, and the triple bottom on the major support, triple bottom on the major resistance. What I have in mean major, I mean the resistance from daily or weekly time frame, and sometimes maybe from 4-hour time frame, but most of the time I will look for them on a daily and weekly time frame. How they are created? Basically, the concept is very easy. After a strong move to the downside, we have the formation of 3 consecutive bottoms, and if we draw the line from the bottoms and from the highs, as you can see over here, we are taking a trade on the breaking through this formation. And as for the take profit and stop loss, of course, it depends on the situation. If it is a very major support or resistance level, I would of course measure this distance plus 1 or 2 pips plus spread, set my stop loss over here, and took this price range and of course multiply that by 2 or 3 depending on the range that we are currently trading on. But those kind of formations, if they occur on a higher time frames, on the major time frames, on major resistance, when they occur, they most often signal a very strong move. So 2 or 3 are at least, we can say, when trading those patterns. Triple top, basically the same concept, but in the opposite direction. When we have strong move to the upside, 3 consecutive tops being created, we have 2 lows, draw the lines on top of them, and again take the range, add pips spread to set the stop loss, took the range from here, and target 2 or 3 hours. Okay, so now let's go and check some examples. But firstly, I will try to, those examples will be from 1 hour time frame, just to illustrate you that also they work, but they need to also be on stronger support and resistance levels, and how and what kind of situations you may came across while trading on the real market. So we have the first scenario when we have a triple top, and we have, there was a clear move to the upside. I need to cut that part to you know, to have a better visual on the pattern. So we have the clear move to the upside. We have the first top, second top, third top, and we have first low, second low. So we are drawing the lines over here and over here, and we have the formation. So where we are entering, of course, over here. When we are setting our stop loss, we add to the highest point of the formation, we add +1 pip plus spread, so it will be more or less somewhere over here. We are targeting in these situations. In this situation, we could target at least 2 Rs. So if you take into account this range, it will not, the measurement will not be perfect, so please forgive me that. So we have basically first move, second move, and yeah, I think more or less we could be profitable at this. This example would be profitable, but what happened? You can see, right, what happened before going straight to the before what happened with the price before going to the downside. You can see the price went down, retested the level, and even break through this channel, inside this channel again, before going to another direction. So you need to remember that you need to always have a plan. So don't panic if the price went back into the channel, and therefore you are starting to think, well, what's happened? If the price will go back, will it touch my stop loss, etc., etc. It is according to the plan. You need to check the highest point, set a stop loss, set target, and then just wait. That is all what you need to do while trading, right? So okay, let's delete that and go and see another example. Okay, so when we have triple tops and triple bottom, now we have a double top and a double bottom. The concept is the same. It is just instead of two triple tops, we have 3 tops, we have 2 tops and 2 bottoms. So I will not explain that. The whole concept is the same as the previous one, so I will just go straight. This is a reversal pattern, so I will go just straight to the example, and this is the first one. We have not so strong move to the upside, but the upward movement was clear here, and this one was surely very, very clear move. And what we have here, the first top, lowest point, second top, and what happened, they are almost at the same levels. So we are drawing, let's delete that, and yeah, let's mark that again. We are drawing the line over here and parallel line over here. And what we are doing, the entry would be somewhere over here. This is a 1 hour time frame, so most likely you would be able to catch that move if you would, for example, set a limit order. And our stop loss, of course, above the highest point of the whole formation. We have here the notch from this candle, so we are adding +1 plus spread. We are setting our stop loss, the price range, and we are taking at least 1 to 2 Rs. This is a small formation, so we could target 2 or 3 Rs, right? So we have basically 1, 2, and more or less we could cash this position somewhere over here. So this one would be a profitable example as well. And of course, we have the continuation to the downside. So that's the first one. Let's go for the other example. This is a double bottom. And you need to have that in mind. Again, this is especially, and we need to have in mind that not always the patterns will be very clear, very easy to spot as it was in this example. So if you would switch, this is a 1 hour time frame. If you would switch to 4 hour time frame, it would look more like more like two tops without any disturbance along the road. But yeah, it is clearly visible if you would go and mark first top, second top, right? Here you have the highest point, which is your level where you are, where we would take the trade, right? So we could go over here. Stop loss, we are adding 1 or 2 plus spread. Stop loss over here. And of course, it depends on the market situation. 2 or even 3R. So it is even beyond this image, but you can trust me that this one also a profitable example. So yeah, as I said, they need to occur, of course, at the major resistance and support levels, but I will be showing you the bigger picture at the end of the presentation. So okay, let's delete that and let's go for another example.